Welcome back to Fast Money. Private credit lenders suffering steep losses this quarter as investors grow jittery over a potential rise in defaults and tighter liquidity. Our next guest flagged risks in the system well before firms like Blue Owl and Apollo started to cap withdrawals from their funds. Says there are more problems lurking. ICG Advisors Co-Chief Investment Officer Terry Monis joins us now. Terry, great to have you with us.
Thanks for having me. Appreciate it.
You know, I feel like everybody's trying to look for the blow up, how it's going to express itself in you know, in terms of being the next great financial crisis. But you're saying it's really the great disappointment that is the worry.
That's right. We should just take a step back a second and say, like, what's going on right now is totally predictable for anyone who's paying attention to the markets and who's a practitioner. It's a credit cycle that's just beginning now. And if you've been through a credit cycle before, you understand that asset liability mismatches arise and they reveal themselves when capital starts to flow the other way, when capital starts to leave a space. This time, excesses build up in different parts of the credit market during during different cycles. Sometimes it's corporate credit, sometimes it's the bond market, sometimes it's MBS, sometimes it's asset-backed or CLOs. This time it was in private credit. It was very obvious to us because we just followed the money. We saw where there was tons of capital flowing in. We saw where there was excess being built up and risk being built up. But the thing is, retail money came in last, and retail money came in through vehicles that are open-ended in structure. They have an inherent asset-liability mismatch. But look, the mismatch is not that great, right? They only allow for limited redemptions, and they tend to be not levered that highly. The problem is there could be a death spiral for these funds. Once an investor sees other investors redeeming, there's a little bit of a prisoner's dilemma, right? So if I see that you're redeeming, I say to myself, wait, I can't not redeem because I'm going to be left holding the bag. Because the investment manager needs to sell assets, build liquidity, and they're usually selling their best assets first. So if I don't redeem, I'm going to be left holding the worst assets. So I have to redeem, and that's a bad situation for everyone. Now, these vehicles can reduce the amount of redemptions that they provide investors, and they have it, which is good. So they're not going to blow up. There might be a few blow-ups because there are some people who did some pretty terrible underwriting, but there's a lot of good underwriters there. There's a lot of good credit managers. So I don't think this will be huge blow-ups, but we think that once investors, ask for their money back, managers have to start defending liquidity. They raise cash. They have to, stop investing into a great market, and that's really bad because you're missing out on the best opportunities. So your returns are not going to be as high as they would be otherwise, and you have to raise cash and you have to, meet your investor redemptions, which means you're just going to disappoint your investors, right? They're not going to get as much return as they expected for taking that illiquidity premium of investing in private credit, and so we just think some of these products were missold, overpromised returns, and it's going to be the great disappointment, unfortunately, for a lot of these retail investors.
Yeah, Terry, you're focused on these companies, right? And you're focused on the underwriting there. Our banks have a lot of exposure, nearly $2 trillion or something like that.
Yeah.
We were just talking earlier about the BKX.
That's right.
Maybe it's that yield curve flattening, but how much do you think is sentiment around the lending to these switch companies?
So yeah, the banks have about 1.9 trillion in exposure to non-depository financial institutions, right? The Fed the government wanted the banks to reduce their exposure and take direct exposure to corporates after the GFC. So private market participants stepped in, and that's great because risk is off the bank balance sheets, which means there's less of a chance of necessary for a government bailout. However, when the banks start to look at their exposure to BDCs, to other private credit vehicles, whether it's NAV lines or warehouse financing or term loans that they've issued, and lent to the private credit managers, that stuff is termed out, so they're not going to be able to pull in that risk. So they can look around to the rest of their balance sheet and say, where can I pull in risk, right? Repo to other funds out there, hedge funds out there, other types of non-bank lenders. And we've actually started to see that. So the most conservative banks out there have started to pull in a little bit of their repo exposure, raise haircuts. And this is in the context of a really bad macro environment, right? We're at war. We have, potential for stagflation. We have slowing growth. And so, credit cycles don't turn just because of one thing. There's usually a confluence of things that sort of conspire to cause capital, a risk-off environment, capital to kind of just get sucked out of the markets. And so, people think private credit is kind of operating in a vacuum by itself, but everything is connected in the financial markets, right? And it's usually connected through the banks, but it's also connected through the investors at the other end. Right, those investors, if they can't get their money to the private credit markets, where else are they not taking risk, and where else are they going to pull the capital from? We don't think there's a big crash coming. We think we're at the very beginning of a cycle. We don't know the magnitude, and we don't know how quickly and how long it's going to take for the cycle to turn, but we definitely think that we're at the beginning of the turn of the credit cycle.
Terry, thanks for coming by. I appreciate it.
Yeah, really appreciate it. Thank you.
Coming up, a robo-taxi in the major market.
Terry, you're gorgeous. Oh my God.